Hello and welcome to this very special edition of Bulls Charge Ahead. I am Anuj Singhal. A large pillar of strength for Indian market has been domestic investments. In fact, Indian mutual funds have seen assets under management doubling in the last 3 years and has now touched $270 billion. And as we at CNBC TV 18 celebrate Mutual Fund Day, we have three very special guests joining us. Sunil Singhania of Reliance Mutual Fund, Anand Shah of BNP Paribas Mutual Fund and Jonathan Schiesel of Ashburton as well. Let's go straight to our first guest. We spoke to Sunil Singhania, CIO, Equity at Reliance Mutual Fund. In fact, we spoke about a lot of issues, a lot of sectors, but we first began by asking him that if there was a correction in the market, would investors pull out or invest more?
No, I don't agree that there have been no corrections. Yes, there have been short corrections. So, you had major correction during Brexit. Though it did not last long in terms of the time. Then we had the same during the US elections, you had the same during demonetization. Only 15-20 days back, you had a very healthy correction, specifically in the mid and small caps. So I think we have had correction. You can be right in the sense that these have not been long in terms of duration. At the same time, I think what has happened over the past few years is that earlier we used to get huge sums of money in a lump sum manner when the markets were very buoyant. This time it's been different. For the last 3-4 years, investors are coming in gradually, month after month. And that makes them a bit more, you can say, comfortable and confident. Because even if the correction comes, they know that they have still additional investments to make. And I think that is what has changed. So our view is that even if there is a correction, our view is that the corrections are going to be short and swift. And second is we do believe that even during corrections, you will continue to see the SIPs particularly, which we have been seeing for the last 3-4 years. So we remain quite positive even as far as inflows from retail investors are concerned.
Sunil, are you keeping the faith on banks, particularly PSU banks? You were just talking to the management at PNB a while back as they go through the motions of this resolution, IBC and non-IBC, all the S4A and other accounts.
So we are banking on a few PSU banks, particularly banks which have adequate capital or are in a position to raise capital. You are right that there are still a little bit of uncertainties. We are not unduly worried about IBC because that is a good medium to long-term solution. It will weed away all the NPAs and find a resolution in a time-bound manner. I think what we are worried about specifically in some of the other PSU banks' name is the consolidation. And that is where we don't have too much, you can say, color and there's a lot of uncertainty. So I think more than the IBC, which we believe can be near-term pain, but a great initiative from a resolution perspective and structural, sort of a scenario where it will dissuade such kind of NPA building up in future. I think more we are worried about banks not being able to raise capital and also the consolidation which the government is talking about.
Okay. Let's talk a bit more about that, Sunil. So how to play this theme? Buy the three largest ones, SBI, BOB, PNB, or do you go down the value curve and, the likes of Oriental Bank or Syndicate Bank? I'm sure you will not take names, but you'll get the gist. Basically, the mid caps and small caps in the PSU space, where the price to book in certain cases is 0.3, 0.4, maybe less than that.
So our preference is for the larger ones, particularly because, as I mentioned earlier, they have the capability. And as in the case of the largest public sector bank, they've been able to raise significant capital. So I think capital is necessary, and our view is that only the larger banks would be able to raise significant capital. So our preference would be towards the larger PSU banks.
Okay, and in terms of private banks, Sunil, we have seen some bit of comeback for corporate-facing banks, but do you think the erstwhile favorite, the retail-facing banks will continue to dominate, or can you look at investing in the corporate-facing ones as well?
So I think the retail banks continue to be having good potential. We all talk about consumption as a theme in India. Banking is the biggest consumption, whether it is ordinary banking or even through some of the other, ancillary activities like wealth management and so on and so forth. At the same time, over the last 1 year in particular, we have started to also build position in some of the larger corporate banks. So right now, our portfolio is a mix between retail banks, because we believe that that's a structural long-term story, and some larger corporate banking names, largely because we believe that we are now at the peak as far as the NPA, you can say, recognition is concerned, and from here on, it will be only recognition. So, you might have 1 or 2 quarters where the NPA provision might be a little bit front-ended because of the government policies. But by and large, those names are already known and factored in. So from here on, we would also be, quite optimistic on some of the larger corporate banks.
So, Sunil, let's now extend this conversation to the NBFC universe, the hallowed part of this market. And of late, we've started seeing this debate whether the best is behind housing finance companies, because now banks are offering you home loans at 8.3% thereabouts. What's your sense? And beyond housing finance, what is it that you'd still back within the NBFC universe?
Again, I think housing as a theme is a great theme. We are obviously a country which is quite short on housing. The government policies are quite conducive. Housing for all, affordable housing has come up as a new theme. But at the same time, you also have to be careful. I think anything which is housing finance in name does not mean that that name should start getting 4, 5, 6 times book. So I think we are very, valuation conscious, and we would avoid housing finance companies trading at 5, 6, 7 times book, because as you rightly said, the competition is increasing. There is a squeeze. Banks are getting a little bit more aggressive. So at least in terms of the very good assets or very good, borrowers, the margins are becoming thinner and thinner. So we remain positive on the segment, but we would be quite value conscious there, and we would avoid housing finance companies trading at 5, 6 times book.
Okay, not housing finance, but what about companies where clearly we are seeing the story of savings moving into financial assets playing out. I'm talking about the likes of Edelweiss, Motilal, IIFL. Of course, your own company is there. You can't invest there, Sunil. But this space has also seen a bit of a re-rating. Do you see more to go here?
So very clearly, the last 1 year, we have repeatedly shared that in financials also we would move to niche financials and companies which would benefit from the shift from physical savings to financial savings. So we have a couple of life insurance companies which are listed. I think they have done quite well also. There will be asset management companies which would be available for investments soon. Already 3, 4 asset management companies have indicated their intention to be listed. And there are then quasi plays, whether it is some of these conglomerate broking companies or even through some banks who have subsidiaries which are quite large and market leaders in their respective field as far as insurance and asset management companies are concerned. So I agree with you that this is a theme which is a multi-year theme, and we do believe that we are just on the cusp of quite decent growth for a long period of time as far as financial savings are concerned. So we would be positive on wealth management, asset management, as well as life insurance companies.
Okay, we'll take a break on that note. Up next, we have 2 more fund managers joining us. Our next guest is Anand Shah of BNP Paribas Mutual Fund, and of course, Jonathan Schiesel of Ashburton will also join in.